So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst, IronFX. In front of your screens, you have your USD's daily chart. All charts to be presented are to be of the same time frame. Sorry, this is the 4-hour chart. Yeah, we had drilled into the 4-hour chart to show some detail. And definitely we need to change that. But before we get into the technicals, let's talk about the fundamentals of the week. Now, we had actually the week began the week before with the release on Friday of the US employment report for April. The release highlighted more or less a cooling US employment market for the past month, as practically the NFP figure dropped more than expected. The unemployment rate ticked up, that was unexpected. And I would be also noting that the average earnings growth rate slowed down. The release as such tended to more or less enhance any market expectations for the Fed to start cutting rates rather sooner than later, and thus tended to weigh on the US dollar on Friday. Now, we had, in the aftermath of the release, on Monday, we had a slow start for the week for the US dollar. Yet it seems to be the case that it was able to rise a little bit more on Tuesday, and even more during today's Asian session. And we are highlighting this as practically we have a number of Fed policymakers, and there seems to be a consistent hawkish rhetoric, which more or less tends to imply that inflation in the US economy remains high, and more or less that may force the bank to maintain rates high for longer. So that tends to provide support for the US dollar, while at the same time could weigh on US stock markets and gold's price. That's one. And I think that may have been even the main driver of the market over the past few days, especially practically Monday and Tuesday. The second issue I would be noting would be the weakening of JPY. I think it has become more obvious since yesterday, but JPY had been weakening since the start of the week. And at this point, it would be interesting to note that the fundamentals which drive JPY's weakening have been on display once again, in the sense that the rather loose monetary policy of BOJ tends to weigh on the Japanese yen as it enhances carry trade. The interesting part, in my opinion, is that actually there are two interesting parts. The first is technical, but on a fundamental level, is the fact that both BOJ and the Japanese government have issued warnings to JPY shorters or sellers. And that's something which the market seems to be neglecting. So I wouldn't be surprised if we see JPY weakening enough, and we see that later on technical level against the US dollar, what levels they may be, we may see a market intervention from BOJ or the Japanese government, or combined. So that's the second fundamental issue I would be highlighting. The third, we had already from Australia RBA's interest rate decision. The bank, as was expected, remained on hold. That was not the issue. That was largely widely expected. There was a divergence, though, between the tone of the accompanying letter and the market reaction. Now, the accompanying letter of the bank practically stated that the bank notes the easing of inflationary pressures, but at the same time also notes that the easing is at a slower pace than anticipated. So that's one hawkish signal. And at the same time, it underscored its resolveness to actually lower inflation within the bank's target. So that's the second hawkish indication. And I would be also noting that we had a rather, or if you prefer, RBA has a rather uncertain outlook, economic outlook about Australia. That would be rather dovish. Overall, the market reaction, though, was on the downside for the Aussie. We didn't expect that. Actually, we would expect that with such a hawkish rhetoric or tone in the accompanying statement, there would be a movement upwards of the Aussie. That was not the case. And our suspicion relies that the market sold the Aussie because it was expecting an even more hawkish accompanying statement, which did not materialize. Now, the third issue would be BOE's interest rate decision on Thursday. That's tomorrow. The bank is expected to remain on hold. No movement. Yet, market seems to be increasingly expecting BOE to start cutting rates in the June meeting. Hence, I would expect that should the bank remain on hold as we expected as well, then I would also place my attention on the accompanying statement and the minutes. Should the accompanying statement actually show a rather dovish tone, which may have been placed in order to prepare the markets for a possible rate cut in the June meeting, I wouldn't be surprised to see the pound losing some ground. On the flip side, should the accompanying statement be characterized by a hawkish, confident tone, we may see the pound gaining, and in my opinion, we may be seeing the pound having more to gain in a hawkish comment or hawkish accompanying statement rather than what it has to lose in a dovish. More or less, a more dovish tone is expected, while a hawkish tone would take the markets by surprise and could provide more symmetric support for the pound. On the fundamental side, that should be it. Let's have a look at the technical, starting with Euro USD. This is the 4-hour chart. I would be noting here the daily chart. So position of the labels. Definitely the R1 has been broken and is now being put to the test as a support line. So let's correct this and color this in green. Let's also place new resistance lines. This peak here is interesting. Could go a bit lower. Yeah. Could go even a bit higher. Nah. In red, that would be the 1.0965, and I would be placing the next resistance line somewhere on this peak here. At 1.1065, so we're talking about 100 pips higher. And the last resistance line would be a little bit narrow, would be in this peak here, that's clear, would be the 1.1140. Okay, we have rounded it up a little bit. And the final support line would be placed here. at 1.0445. Let's try 50 just to have a look at that. Hmm, 45. Okay, let's play some. So give me a sec. Small mistake here. In green. Okay, lock this in. Let's place some labels, at least for the first 3 in each direction. $1.0965, R2 at 1.0885, R1 at 1.0681, S1 at 1.0740, S2 at 1.0680, S3 at 1.06, this is the daily chart. Interestingly enough, is whether we have an upward channel or not. Let me reverse that. Could widen it a little bit, shift it to the right, narrow it. It's preparing to make a higher throw here. Back to the forward chart. Okay. It seems as if the upward channel is in place. On the other hand, though, we see a relative stabilization of the pair between the S1 1.0740, at which it has bounced during today's early European session. And to the upside, it seems to be moving between, we're setting as an upper boundary of the sideways movement, the R1 1.0810. Now we're talking about 60, 70 pips distance between the S1 and the R1. That's not much. The euro could go for higher in a day. At this point, I'll allow me to delete this. So for the time being, we tend to maintain a bias for the sideways motion to continue. I know and I can see the upward channel, but in my opinion, for a bullish outlook to be justified, I would require a clear break of the R1 1.0810 and the price action to start moving for the R2 1.0885. Should the bears take over, we may see the price action dropping, breaching the S1 1.0740, and definitely it would be breaching also the low boundary of the upward channel and starting to aim clearly for the 1.0680. The RSI indicator, on the other hand, is running along the reading of 50. It's actually just below it, implying a rather indecisive market, which may allow the sideways motion to continue. I would be also noting here the narrowing of the Bollinger Bands. You can see it here. You can see how the upper and the lower Bollinger Band are converging. And that tends to imply low volatility for the pair. And should that be maintained, should the low volatility be maintained, that would be another signal that the sideways motion may be allowed to continue. In a nutshell, on technical level, Euro USD is expected to maintain a sideways motion. For a bullish outlook, we would require a clear break of the R1. And for a bearish outlook, I would require a clear break of the S1 and the price action to actually test the S2. Okay, let's have a look at USD-JPY. It has a very, very different picture. This is the 4-hour chart. Let's replace the labels. 150.80 at the S3, S2 152.70, 154.50 at the S1, 156.30 at the R1, 158.30 at the R2, and the practically 35-year high at the R3, 160.20. Now in the 4-hour chart, you can see there's a clear upward trend line guiding the pair. I think that's more than obvious. JPY is weakening, and that's being reflected also on a technical level. Please note also the RSI indicator, which has started around the beginning of the month with actually the 3rd of May. This is, yeah. From the 3rd of May, it bounced on the reading of 30, which it was very low, rose, breached the reading of 50, at some point wobbled around the reading of 50, implying some stabilization, and then continued higher, and it's currently at 60.3. So more or less we see a bullish market sentiment being slowly built up among market participants, and that could be a drive higher for USD JPY. Once again, though, I'm a little bit hesitant about the upward movement, and I would like to see the pair's price action breaching the R156.3 before actually reversing, or if you prefer, adopting a bullish outlook. For a bearish outlook, I would require the pair to breach the pre-mentioned upward trend line, breach the S1 154.50, and start actively aiming, if not even testing, the S2 152.70. On the other hand, the pair may find some resistance as it's been hitting over the past 16 hours or so on the upper Bollinger Band. So there may be some stabilization here, but for stabilization, I would expect the first signal to be a breach of the pre-mentioned upward trend line. Yet at the same time, the price action to respect the R1 and the S1 and remain within the corridor set by the two pre-mentioned levels. Let's have a look at USD CAD. Or before that, let's have a look at the pound against the dollar. Cable. Cable in a very similar movement like the euro, in my opinion, however a little bit more intense. Now, cable seems to be moving and respecting, this is the daily chart, the channel set between the R1 and the S1. Some traders tend to highlight the possibility of a downward channel back into the daily chart. You can see how we have lower peaks, lower trough. Yet for the bearish outlook to remain intact, or to be maintained if you prefer, you would require a lower trough than this one. So practically the pair has to start falling and continue falling for a number of days, breach the S1 1.2350, become lower than this one, and start aiming thus for the S2 1.2180. On the other hand, should the bulls take over, we may see the price action rising, reversing direction actually of the past 2 days, breaching the pre-mentioned downward trend line. Yet I would require also the pair to breach the R1 1.2560, and should this peak be surpassed, practically the price action has to reach the R2 1.2710 before actually correcting lower. That would be a total reversal, and what would be practically adopted here would be a bullish outlook. Why? Because you would be having A, higher truths, B, higher peaks. Let's have a look at the Aussie. Okay, let's reposition the labels a little bit. Here you go. Now, AUD USD, and this is the big question here, has been an upward motion. The pair has started rather low at the S3 and has rose, forming a peak, corrected lower, show. The next peak was higher than the previous one, and it was at around 0.6635, and now it's correcting lower since yesterday. It would be interesting to see the market reaction at the time of the release of RBA's interest rate decision. Let's drill into the minute chart, unlock it, widen the chart, going back. Here you go. This wide red candlestick of around 26 pips was practically caused by the RBA interest rate decision. And I would be noting here that even following the decision, the pair failed to regain the losses it made. There was a slight attempt for a correction higher. That was at around up until 8:30, sorry, up until the European session began. A little bit earlier than that. And you can see how then it went all the way downhill once again. So there was not a tumbling, but a notable downward motion of AUD USD, which was caused by RBA's interest rate decision. Let's readjust the chart, drill into the daily chart. So what do we do? For the time being, we tend to expect the downward motion to continue. But in the long run, we tend to remain bullish. As long as the upward trend line remains intact, and the upward trend line was incepted since the mid-days of April, actually the 19th of April. As long as the upward trend line remains intact, we tend to maintain a bullish outlook for the Aussie. And that would imply practically a breach of the R1 0.6635 and the price action of AUD USD to start aiming for the R2 0.6725. Okay. Let's have a look at the CAD, USD CAD. It should be dropping. It's not. Yes, and it's understandable why it's rising. It's rising because the US dollar has been rising over the past 2 days. One exception would be on Monday, where we had a rather stable US dollar. It was a rather lazy start of the week for the greenback, and that allowed the Canadian dollar to drive the pair a bit lower. Overall, the big picture of a sideways motion between the S1 and the R1 seems to be maintained. Allow me to make some technical corrections here. Definitely the R1 has to be turned into support line. Let's color this in red, as it is a resistance line. And the resistance line is practically laying on this peak here. Let's place some labels so we get some more clarity here. Starting with the R3, which is now placed at 1.39, the R2 at 1.3845, the R1 at 1.3780, $1.3717, for the S1, the S2 at 1.3637, Okay, that should be it. I think we're clear. There is only one critique for the resistance support lines I have set, which could be come under fire. It would be that practically the distances between the resistance and support lines are a little bit narrow. But in my opinion, we have, especially for the resistance lines, we have 3 peaks which are quite valid, and I tend to keep the resistance line for that reason. So for the time being, we tend to maintain a bias for a sideways motion to be maintained between the S2 1.3637 and the R1 1.3780. We're talking about a distance of around 143 pips. For a bullish outlook, I would require the pair to breach the R1 1.3780 and actually starting to aim, if not breach also the R2 because it's very near, the 1.3845. We're talking only about a distance of 60 pips. So from the current price action of 1.3750 up until the R2 is only 100 pips, not even 100 pips. So it's quite feasible. That's my opinion. For a bearish outlook, we would require the pair to drop, breach the S1 1.3717, but also I would require clear break of the S2 1.3637. Let's have a look also at WTI, because WTI usually or at some points tends to also affect the prices of the Canadian dollar given Canada's status as a major oil producing economy. Whoa, that's going down the drain. Let's drill into the daily chart. Okay. Back to the forward chart. Definitely this resistance line, this downward trend line has to be shifted. Back to the daily chart. Placing a new ultimate support line at 71.50. Let's have a look. Yep. And I'm basing this on this show here. Note how there was an intense downward motion which was reversed at 71.50. Let's reposition the labels. I think that the downward motion of WTI's price is clear and tends to dictate a bearish outlook for the commodity's price. So I wouldn't be surprised to see it reaching, if not breaching, actually, the S178.20. And the next possible target for the bears could be the S275.90. On a fundamental basis, I would note that the rise of US oil inventories may add more selling pressure on oil's prices. And that's why we would be also highlighting the release of EIA's crude oil inventories figure. It's a weekly figure, and it's due out during today's American session. It could have some intensification of the bearish tendencies for oil's prices should there be another increase of US oil inventories. That would imply practically that the demand levels in the US economy were not able to catch up with supply levels, with production levels of oil in the US economy. So that allows for a slack to be created in the US oil market, which in turn raises the inventories of oil reserves in the US and thus makes more oil available for consumers, forcing sellers to reduce their prices, i.e., that's why we see also some bearish tendencies for WTI. On the other hand, I would be noting here that we still have the issue in Gaza, which could at any given moment erupt once again, or if you prefer not erupt, it's already ongoing, intensify. And in such a case, we may see some bullish tendencies being built for oil prices. Why? Because there would be worries about a tightening supply side of the commodity at an international level. For the time being, the bearish outlook is present. It's characteristic also how the RSI indicator has hit a floor and stayed there at the reading of 30, which tends to imply a rather strong bearish sentiment on behalf of the market for the commodities price. I would also be noting that we have the price action, which is actually hitting on the lower Bollinger Band, which may slow down the bears a little bit. but overall the downward motion trajectory is expected to be maintained for the time being. For a change of outlook, I would require the commodities price to reverse direction, breach clearly the pre-mentioned downward trend line, breach the R180.17, and oh, that's a mistake, sorry. We had to correct it. Breach the 78.20 support line, resistance line, breach also reach the 80.17 resistance level. See, that's the mistake we make when we don't correct the labels. This is the 82.80. This is the 80.17. This is the 78.20. The S1 is the 75.90. The S2 is the 73.65. And the S3 is the 71.50. Okay. I think that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Everyone, let's go ahead and get started. So today's webinar will be on pivot point trading. And before we get started, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. Firstly, we're going to be looking at what exactly are pivot points, followed by what time frames you should use, and then the different types as well, and adding them into your strategy. Okay. So what are pivot points? Okay. So pivot point is It's a pretty popular trading analysis strategy that's commonly used by traders to determine potential levels of support and resistance in the market. So pivot points are basically calculated using the previous day's highs, lows, and the closing. So a series of points are derived from those values. Okay, so just for your information, if you're wondering how exactly can you implement it into your trading strategy, so you would first calculate the pivot point, okay, which is basically the average of the previous day's high, low, and close prices. And this is the most important level because it represents the um, it basically represents the points at which market changes direction, which is why you can then use them as support and resistance levels. Okay. And then the first support level is calculated as 2 times the pivot point minus the previous day's high. And then the first resistance is calculated as 2 times the pivot point minus the previous day's low. And then the second support and resistance levels are calculated by adding and subtracting the difference between the previous day's highs and those to and from the pivot point. Okay. Yeah, but we'll get into that in the next few slides. And normally these points are calculated for you already. So these points, it's important to note that the pivot point trading strategy should be used in combination with other technical analysis tools, because they tend to be predictive instead of lagging, which uses information from the previous day to calculate potential turning points. Okay. Some basic points. So this is what I was talking about how to calculate your pivot points. Okay. But yeah, as I mentioned, these are normally calculated for you. But yeah, so firstly would be to calculate the pivot point. Secondly, calculate the support and resistance levels. And then lastly would be to use the levels as entry and exit points. So if the market is approaching a support level, you can consider buying. And if it's approaching a resistance level, you can consider selling. Okay. Okay. So there are a few types of pivot points. Okay, so firstly, we have the standard pivot point. So this method involves using a simple calculation to determine the pivot point. So that's basically the average of the high, low, and closing prices from the previous trading session. And then the support and resistance levels are then calculated based on the pivot point. Can you get the slides? I don't think that we send out the slides, but this webinar is recorded and I think it will be posted on YouTube, so you can refer to it whenever you want. Yeah, I think the IronFX YouTube is just IronFX on YouTube. Yeah, should be. Yeah, if you're unsure of anything, feel free to just email IronFX. You can get the email on the website. Sure, no worries. Okay, and then our second point is the Woody pivot point. So this method uses a really similar calculation to the standard pivot point that we just talked about. The only difference is that there is a different weighting of the pivot points. The pivot points. So like the high, the low, and the closing prices. So the support and resistance levels are calculated based on the pivot point with additional levels of support and resistance added based on the difference between the pivot point and the high, low, and closing prices. Okay. Thirdly, we have the Camarilla pivot point. So for this method, it's based on a pretty complex calculation. Okay, it involves using multiple levels of support and resistance. And the formula for calculating the Camarilla pivot points includes 4 support levels, 4 resistance levels, and the pivot point itself. Okay. Okay, fourth, Fibonacci pivot point. So this method uses Fibonacci retracements to determine the pivot point and support and resistance levels. So the pivot point is calculated by taking the average of the high, low, and closing prices, and then adding or subtracting a Fibonacci retracement level from the pivot point to determine the support and resistance levels. Okay. And lastly, we have the demarc pivot point. So this method uses a series of complex calculations as well, but the calculations basically take into account the relationship between the previous trading sessions, high, low, and closing prices. Okay, but also the current trading session's open price. So the main differences between the various pivot point trading strategies are just the formulas that are used to calculate the pivot points, but also the placement of support and resistance levels. So depending on your personal preferences and the specific characteristics of the market that you're trading, you can then implement these different methods. Okay, so let's look at them, look at the pros and cons for each of them. So firstly, we have standard pivot points. The pros of this is that it's pretty easy to use. So it's the most widely used pivot point method. It's also easy to calculate and understand, provides a good overall picture of support and resistance levels. Cons is that it may not work well in volatile markets, and it doesn't take into account the opening price, which may be significant in some markets. It's also less accurate than other methods in certain market conditions. Okay. Next we have the Woody pivot point. So some pros of this is that it's pretty popular with short-term traders. So if you're a scalper, this would be probably a better option. So this uses the current period's opening price and provides more weight to recent price movements. Okay. Cons is that it's less used as it's less effective for long-term trading and it may not work well in markets with low liquidity. Okay, next we have the Camarilla pivot point. So some pros of this is that it's popular amongst day traders and provides more support and resistance levels compared to other methods and can be used to identify potential breakouts. Cons is that it can be difficult to calculate as well as understand, and it might not work well with markets with low liquidity and may require more frequent adjustments compared to other methods. Okay. Next we have the Fibonacci pivot point. So this uses the Fibonacci retracement levels to identify the support and resistance levels. So if you are wondering what is Fibonacci, okay, maybe I will show you guys in a little bit. But it can be effective in trading in trending markets and can be used in conjunction with other Fibonacci tools. Cons is that it may not work well in volatile markets or markets with low liquidity and can be less accurate than other methods in certain market conditions. So it's all really based off of the current market conditions that you're looking at, as well as your own personal trading strategies. Okay, demarc pivot point. Pros is that it's popular amongst institutional traders and can be used to identify potential trend reversals, provides multiple levels of support and resistance, but cons is that it's difficult to calculate and understand and may require more frequent adjustments compared to other methods and may not work well in markets with low liquidity. Okay, so some timeframes that you can consider when you're using this. Firstly, what I want to highlight is that for this time frame in this example, we're on the M15 view, and you can see that it's pretty unclear. Like the market structure is unclear. If we're looking at this example, when I change, it's the same chart, okay? If we're looking at the same chart, but on a H1 view, we see that the market structure is a lot clearer. So the point that I'm trying to make here is simply that um, the clearer the swing low and the clearer the swing high, the clearer the trend between these 2 points, the more accurate your analysis will be. So here I'm talking about Fibonacci retracement, but of course, this applies for pretty much anything, like your pivot points as well, because especially for your Fibonacci pivot points. Okay, but the time frame formula for pivot point strategy for intraday it's H4 and weekly it's monthly. Okay, now let's take a look at some charts. Okay, let me just pull out my charts. Okay. Okay, so let's take a look at maybe pound yen. Okay, just a super random example to show you guys. Okay, so I like to start off by looking at it on the higher time frames first. So I'm gonna look at it from a weekly time frame so that I get an idea of where prices are headed towards. Okay, so on our weekly time frame, we see that prices are in an uptrend. On the daily time frame, we also see them in an uptrend. And on a 4 hour time frame, it's also pretty bullish, except there is a slight reversal over here. Okay, so let's go ahead and analyze this together. So if I'm using pivot points as support and resistance levels, for example, also let me know in the chat if you guys normally use pivot points. Okay, so I'm looking at this on the because my chart I'm using now is the 4 hour time frame. Okay, so I'm gonna change to um mm, okay, so if depending on which time frame you are looking at. So in this case, if I'm looking at the 4 hour time frame, you obviously wouldn't want to be looking at the quarterly time frame because it's a bit covers too much of the time frame. Okay. So you might want to stick with either monthly or even weekly. Okay. But I typically prefer monthly because weekly is a little bit um too recent. Okay. And I also prefer to just look at okay, if you look at here, the settings for pivots, this is the pivot point for standard. Yeah, the standard settings. Okay, so I will look at the pivot, the S1, but I don't typically like to look at the others because it tends to get too um convoluted and I don't like my charts to be too messy. Okay, so I like to just filter it out to just look at the pivot point as well as the first two supports and the first two resistance levels. Okay, so from here, this is actually a really good aid to help you determine where you should place your support and resistance levels. Because you can see here where my R2 is at, this is typically where you would place your R1 anyway. Okay, because your first resistance would be the closest swing high to where price is currently at, which is over here. Okay, so and then followed by, you see this R1 here. If I follow that, I'm at this next swing high, which I would have placed here anyway. So it's basically telling you, um, basically helps you to support your support and resistance levels. Okay. Oop, no, this is my first support. Okay. Especially in this situation my where this is the highest level, in the sense that I don't have any other reference swing highs where I can place my next second resistance. That's where these levels come in pretty handy. Okay, so we go in with this first, and then I can adjust it later with my Fibonacci levels. Okay, so I'm gonna place my first support there, maybe my second support here. Okay, okay. So because we typically want to follow the trend, and here we see that it's an uptrend, and on our daily as well as weekly time frames, we've also seen that it's an uptrend. So we'll typically follow the direction of the trend, unless unless we think that price is gonna reverse. Okay, but from the start we would just go with the trend. Okay, so here now I'm going in with my support and resistance, I mean my Fibonacci levels. And here, the first thing I'm going to do is using a Fibonacci projection. So this tool here that I'm using, this tool, it's called Fibonacci extension. Okay, trend-based Fib extension, but we call it a Fibonacci projection. Let me just hide this so that it's not so messy. And you can see that my Fibonacci projection levels actually match up with my first resistance, first support, and second support. Okay, and in order to use this, we want to look for a flash kind of shape like this. Okay. Next, I'm going to go in with a Fibonacci extension. So for Fib extension, we are looking at the values that are greater than 100. So namely these two. Yeah. But you can look at this as well. Let's see if there's any others. Yeah, but namely those above 100. Okay, and for this, well, the kind of shape that we're looking for is a Nike tick. Okay, so it has to retrace 100% of the head of the tail, of the head of the tick. I mean, of the head of the tick, it has to retrace 100% of it before you can go in with this strategy. Okay, but you're basically looking for a V shape or a tick. Okay, so if we look at this tick here, this Nike tick shape. Mm, okay, maybe I can draw it here instead. No. Okay. Yeah. So for my Nike tick, you can see my 127 lines up with my 100% as well as my first resistance here. So let me highlight it here. Okay, and then my second resistance kind of lines up with my 141. So I'm just gonna adjust it below here. And then we have a 161, which is quite a distance, so I'm gonna just ignore that for now. Okay. Okay. Now let's go in with a retracement. So for Fibonacci retracements, we use these 5 levels. Okay. And then you can see that my 23.6 lines up with my first support, and so does my 50%. Okay, so I'm just gonna keep my those 2 levels. Okay, so if I put back my pivot points, and change this to monthly like it was earlier, you can see that it has helped me to identify certain resistance as well as my support levels. Okay, you can see my R1 is at my first support, first resistance is there, supported by a whole bunch of Fibonacci values. So this helps you to get more Fibonacci confluence areas, which you would know is pretty significant because um, it basically areas of Fibonacci confluence, like over here, your first resistance, tends to attract price more. So then you can predict whether prices are going to reverse off of it, are going to test that level, so on and so forth. Okay, let's finish our analysis for this chart and then we can look at another chart. So as I mentioned earlier, we're gonna go in for a buy because we tend to follow trends, right? So even though we see it reversing off of our first resistance, let's see, price is moving above the Ichimoku cloud and MACD is also giving us a bullish signal. Okay, so it supports our bullish analysis. Let's look at RSI. Okay, RSI is also giving us a bullish signal. Mm, cool. Okay, it's also giving us a bullish signal. And um, let's see. Let's look at EMA and SMA. Okay, we can see price moving above both of these values. So it's also giving us a bullish signal. Okay, so pretty bullish over here. Yeah, we might see a reversal back to our first resistance because it does tend to attract price. And when that happens, we can go in for a buy towards our next resistance, which is the second resistance here. Okay. Okay. Next. Any questions? Any charts you guys would like me to go through? Okay, let's go ahead and look at the Aussie dollar. Mm, okay, on our weekly time frame, okay, we see prices being pretty bearish. Okay, with prices moving in this descending trend line. So just to recap, what makes a valid trend line is if there are a minimum of 3 touches on our trend line. But here we have 4. Okay, but yeah, minimum 3. And then on our daily time frame, it is, yeah, we also have a descending trend line. So also pretty bearish here. Okay. Let's look at our 4-hour time frame. Okay, now 4-hour time frame looks pretty bullish. Okay, we see prices moving upwards. Okay, now let's go in with our Fibonacci, or rather our support and resistance levels, because we don't have any trend lines or trend channels. Okay, so here's my first resistance. Actually, because this is pretty close to where price is currently at. So I'm just gonna label it like this. And then maybe over here for my first support. And here for my first resistance. Okay. Okay, now let's check our support and resistance levels using our pivot point indicator. Okay, I'm using 4 hours. So my pivot time frame, I'm gonna put it as monthly. Okay, can you guys see how my resistance levels line up with my support and resistance levels? Okay, the only one that doesn't line up, you can see, is my first support, which is pretty far away from these levels here. But I can see that my support level here shows me that I can pull it back here. Okay, and then now I'm in line with another one here. Okay, so you can use the pivot point strategy to support your levels and adjust accordingly. Yeah, but it can get a little bit messy, so you can always, there's always the option of um hiding it in the meantime while you are doing your Fibonacci analysis. Okay, so now that we've done that, I'm gonna go in with our Fibonacci levels, and you can see that. Okay, my 78.6 lines up nicely. Just gonna keep that. And maybe my 100 as well. And let's see. Okay, I'm gonna check for a Fibonacci expansion. So for expansions, we use the negative numbers. So earlier for extensions, for the Nike tick, we were using the values that were greater than 100, and now we're using the values that are less than 0 for expansion. And for expansion, similar to projections, we are looking for this flash shape or like a lightning bolt kind of shape. Okay. So I can see that my minus 27.2 lines up with my first resistance. Okay. I'm gonna ignore the minus 61.8 because it's pretty far away from where price is currently at. Let's see if we have any other levels. Okay, I think I have a retracement over here. For retracement, remember we use these 5 levels. Okay, My 50% lines up, and so does my 38.2. Okay. So you can see the number of levels lining up over here at our first resistance. And I mentioned earlier that confluence areas tend to attract price. So we can likely expect price to continue to rise and be attracted to our first resistance. Okay, but you can see here my intermediate level, this dotted line, intermediate resistance. It does also have a bit of a confluence area because you can see I have 3 pivot point levels that are lining up with this area. I also have 2 Fibonacci levels lining up,